All right. I'd like to start off just by saying welcome. It looks like we've got a pretty good turnout for tonight. Tonight we're going to be talking about dependents. We're going to be talking about who they are. They are not always kids necessarily, and we'll go into that detail here. We're going to talk about why they are beneficial on your client's tax returns as well. Before we get started, just want to do a little quick overview for you guys that this might be new to you. The interface that we're using on the right-hand side of your screen does have a question or chat panel there. Please feel free to type in any questions as they come up. We very well might address them kind of real time as we're going through the presentation, or we might hold off until the end when we will be doing a live question and answer session, and we will try to bring any and all of those questions up for the benefit of the entire group as well. Also, you'll notice there on the right-hand kind of control panel, there are two handouts set up for this presentation tonight. They are the slide decks that we will be walking through. Please feel free to print those out, use them as reference material, take some notes on them or something if you'd like. But they will also be available with the archive presentation in your web portal approximately 48 hours after we wrap this up this evening. The second handout on there is a really nice flow chart that goes hand in hand with the presentation as far as who can you claim as a dependent. And by the end of this, hopefully you guys won't even need that flow chart, but it is there for your benefit. Last but not least, we will have a couple of polling questions that we will launch throughout the webinar. Those polling questions are simply there just to make sure that you guys are awake and moderately attentive on the other end of the presentation. The IRS likes to know that you guys are paying attention. So we simply launch those, make sure that you answer the questions. Doesn't matter if you get the question right or wrong. It's just strictly for participation points, so to speak. But otherwise, with that being said, I'm going to go ahead and we will turn it over here to Derek. And Derek, I will let you and Richard run with it here. And I'll be manning the question section here. So like I said, feel free to fire in those questions as we go.
Okay, tonight we are going to be going over dependents. Who are they and what benefits do they provide? Basically, in terms of our course objectives, what we're going to do is determine the credits, the exemptions, and the filing status that is going to be used in regards to dependents. We're going to talk about special filing requirements, discuss different types of income, how they relate to dependents and the various types of credits and benefits that are there. We're going to talk about some document retention and due diligence standards. Very briefly, we will have a future webinar over due diligence coming up in a couple of weeks, but this will very briefly touch about the due diligence requirements that we have in regards to dependents and talk about the state of affairs and tax considerations with dependent filing. We're going to be going through a lot of content during the course of this evening, and as Joe mentioned, feel free to use the question panel over there on the side. If we are not able to get to it, like if the question, for instance, is highly specific, then obviously feel free to call us during normal business hours as well, talk about your specific scenario if we can't get to it today. So, first things, what is a dependent? So very loosely, a dependent is what the IRS considers anybody who is other than the taxpayer or a spouse, if you're filing jointly, whose presence on the return basically gives that taxpayer an exemption. In order to do this, a dependent has to pass a series of what are known as tests in order to qualify as a dependent. So if you're looking through any of the publications like Pub 17 or whatever, they talk about tests. These are just basic series of yes or no questions that essentially are, need to be answered in order to determine whether they're a dependent. It's the same process used on the flow chart that's over there on the side in the handout section. And what dependents do is they provide taxpayers with additional opportunities on their return for those exemptions, those credits, those different filing statuses, other preferential tax treatments for certain income and expense categories. It just basically provides like a large array of benefits that can help your client out and essentially boost their refund or make them owe less tax. In order to be considered dependent, as in who can be considered dependent, they have 5 tests essentially that need to be met for someone in order to be considered a dependent. The first one is called the qualifying child test. That has its own tests inherent to it, but that's the first one there. Is this person a qualifying child? We'll cover this in the upcoming slides. Next one is going to be qualifying relative. If they're not a qualifying child, are they considered a qualifying relative? So that one right there is the next one. The dependent taxpayer test, as in whether or not the taxpayer is considered a dependent of another. The joint return test, as in whether or not the dependent is filing, or this particular taxpayer is filing a joint return, and whether they're a citizen or resident, which is the final test out of those 5. If a person must be considered a qualifying child or qualifying relative. Those are the first 2 tests. So we're going to actually expand upon those because those are the ones where most of the confusion happens to set in, and they are based primarily on the age, relationship, and residency of the individual to the taxpayer. And after the determination of the qualifying child or relative status, they have to satisfy the dependent, joint return, and citizen or resident tests that we mentioned earlier. And the first things first, like the part that really hinges upon the difference between a qualifying child and a relative, is you hear these terms get bandied about when we're talking about this in tax terms, and they are highly specific and they have different benefits that are associated with them. And the qualifying child is first and foremost predicated upon the relationship to the taxpayer between that dependent. So in order to be considered a qualifying child, a person must satisfy the following conditions. They must be the taxpayer's son or daughter. That includes stepchildren, adopted children, and foster children, or any descendant of these, so grandchildren, great-grandchildren, and so on. Or they have to be the brother or sister of the taxpayer. That also includes step, half, and adopted siblings or descendant of any of these people, so the taxpayers' nieces and or nephews. And before I hand this over to Richard so we can kind of elaborate a little bit on the age tests, what we're going to do is I'm going to have a family tree drawn here, and I like to mention this as a sort of like a little tagline in relation, is that the relationship for a qualifying child needs to be at your generation or down. So if you have a taxpayer right here at the middle of these little arrows, you can see that his brother, his brother's wife, or their children or his children, those are all good. If you have to go up the family tree, they cannot be considered a qualifying child. So you might still be able to claim somebody other than those relationships as a dependent if they're a qualifying relative, which we'll talk about in a little bit, but to be considered a qualifying child, which is the best one in terms of the most benefits associated with it, they need to be at your generation or down. So your own children, your brothers and sisters, their children, and any of those can be related, half, step, adopted, and so on. And I think I'm going to go ahead and hand this one over to Richard if you want to go ahead and start talking about these age tests.
All righty, and this is me. It's nice to see a lot of you guys out here. I think I recognize you from training. Let's talk about the qualifying child, the age test. To meet this test, the child must be under age 19 at the end of the year and younger than the taxpayer or the spouse if filing jointly. And they can also be a full-time student under 24 years of age at the end of the year and younger than the taxpayer or the spouse if filing jointly. Of course, if they're permanently or totally disabled at any time of the year, it is regardless of their age. Now, special importance is at the end of the year is important because the person does not meet the age test if the age exceeds the threshold at any time during the year. As mentioned, permanently and totally disabled persons can be any age and still pass the test. Going on to the next slide, full-time student is further explained. To be considered a full-time student for the age test, the person must attend a school for some part of any 5 calendar months of the year. That is a regular staff, a course of study, and a regularly enrolled student body, or a full-time farm training program described by a state, county, or a local government agency. A school must be an elementary school, a junior or a senior high school, a college, a university, or a technical trade or mechanical school. Now, on the job training, correspondence courses and internet-only schools do not count as a school. That said, if they meet any of the above and offer on-the-job training, correspondence courses, and internet only, they do qualify for being a school. And last, high school students who attend a vocational school or attend co-op jobs in the private industry as part of their regular coursework are still considered students. On the next page, permanently and totally disabled, to be considered thus, both of the following must apply to the child. He or she cannot engage in any substantial gainful activity because of a physical or mental condition. Substantially gainful activity in this sense refers to the act of completing work or services, etc., for compensation. And then a doctor must determine that the condition will last at least a year and could lead to the person's death. So basically, reiterating all of this, a qualifying child must be 18 or younger, no special restrictions. 23 or younger, they must be a full-time student. And 24 and older must be permanently and totally disabled. And it's turning back over to Derek for residency.
All right. Just to sort of elaborate on the one point when we're talking about permanently and totally disabled, this last sentence right here is that they can't basically work or be able to work for money, and then the doctor has to say that it's going to be at least a year long that they're going to be this condition, which for the purposes of the taxes allows it to be claimed for that year, or if the disease or condition or disability at any point could cause that person to die, then essentially they're considered permanently and totally disabled. So just keep that in the back of your head. We'll talk a little bit about document retention coming up. Going on to residency, this is another one where there's a lot of confusion. The age is not really so much of a big deal. Like the age is pretty easy to find out. You have birthdays. In most cases, the software determines it. Residency is the one where there's probably a lot more of a hinge point. This is the one the IRS likes proof for. In order to meet the residency test, a child needs to have lived with the taxpayer for more than half of the year. And when I say child, I'm still referring to qualifying child, so that can be children, grandchildren, nieces, nephews, and brothers and sisters. So keep that in mind. And there are exceptions, by the way, for residency for things like birth, death, kidnapping, the children of divorced or separated parents, divorced or separated parents. The temporary absences, when I'm talking about these, essentially a child's considered to have lived if they're temporarily absent because of things like an illness or business, education, military service. If there's something like that, like they're in the hospital or they're away at school, if the mail is still coming to the house, if they're still technically legally living with the parents, then those temporary absences don't count. It's not going to, you're not going to need to go through and subtract a couple of weeks because they were in the hospital, okay? There's also a rule that essentially says that if a child is either born or dies during the year, they are considered to have lived with the taxpayer the entire year, as long as their home is considered the taxpayer's home during that year. So that obviously excludes any of the time they spent in the hospital or stays in the hospital due to birth. They're considered to have lived with the taxpayer during those. A good example would be if you have a kid during the last couple of days of the year, maybe you don't actually get out of the hospital to go home until January the 1st or 2nd. Still technically they lived with you in the home during December. You're not going to need to miss a year just because you were in the hospital at that time. Similar situation with children who pass away. If they are born alive, they can still be claimed on a return. It's kind of a bittersweet scenario, but if you have someone who was born during the year and dies during the same time frame, they can still be claimed on the return as though they were alive the whole year, as long as all the other required tests are met and there is sufficient proof of live birth from the state or local government. You can still claim the exemption even if they only live for a moment, which naturally leads into the last bullet point right there, is that stillborn children cannot be claimed. They need to have an actual birth certificate that states that they were physically alive, even if it was only for a second, in order for it to be claimed if you have a stillborn child that cannot be claimed. You also have the condition that kidnapped children can meet the residency test if the following two conditions are both met. They are presumed by law enforcement agencies to have been kidnapped by someone who is not a member of the taxpayer or the child's family, and they must have lived with the taxpayer for half of the time preceding the kidnapping. And that treatment applies for all years until the child is returned. So the last, and you can essentially keep claiming a kidnapped child as long as those conditions are met up until the year of determination that the child is considered deceased, or the year that the child would have turned 18, in which case you could no longer have that person considered a qualifying child. When you are continuing further into this, before I toss this back over to Richard to go through some of these special rules, you also have children of divorced or separated parents that have an additional set of rules over it. Typically, the exemption for the child belongs to the custodial parent, aka the person who has the legal custody of that particular child. However, the exemption can pass to the non-custodial parent if the following four statements are true. The parents are divorced or legally separated, separated under a decree of separate maintenance, or lived apart at all times during the last 6 months of the year, whether or not they were married. If the child receives half their support from the parents, if the child is in the custody of one or both parents for over half the year, and the custodial parent releases the exemption. The important thing to pull away from this is that they lived apart at all times the last 6 months of the year, whether or not they were married. And that right there is a really, really important thing, because the IRS has a designation that they call considered unmarried that we'll probably touch on a little bit, and that essentially allows, for instance, a separated couple, a married couple who is living apart from one another, that didn't live together during the last 6 months of the year, then their child can be considered a qualifying child and have them treated as a head of household instead of the much worse filing status married filing separately. So I think I'm going to go ahead and pass this back over to Richard so we can talk about some of these special rules.
All right, so special rules dealing with custodial parents. The definition of custodial parent is a parent with whom the child spends the greatest amount of time. This time is generally considered the amount of time spending the night with the parent. If the parents split partway through the year, the time is for the part of the year when the parents were separated. Now note, if a parent works nights and the child spends the greater portion of the day with the second parent, even while sleeping at the home of the first parent, the one working nights, the child is considered to have spent the greater time with the second parent. An equal time spent. If the child is considered to have spent equal time with both parents, the custody of the child for these tax purposes belongs to the parent with the highest AGI. For emancipated children are not considered as living with either parent. Special rules for divorced to separated parents do not apply, and time spent defaults to the number of days spent with either parents. The parent with the most days is considered the custodial parent. Going on, some more special rules. Absences. Children spending the night somewhere else, such as with a friend or a family member, are considered to have spent the night with the parent for whom they normally would have spent the night, with assuming the absence was temporary in nature. If no rules can establish whom the child would normally have stayed with, the child is considered to have stayed with neither parent. An example of that is if, say, Timmy spends the night at a friend's house. Timmy usually lives with his mother, and as a rule, Timmy is considered to have stayed with his mother even during the absence. However, if Timmy usually spends exactly equal time with both parents, his absence isn't counted for either parent. Going on to school days. If no other test can be established, which parent the child resides with, the child is attending a school, the child is considered to reside with the parent whose address is registered for this child's schooling. An example is if Timmy's mother works nights as a waitress for a local pancake house. Usually Timmy's dad watches him during the day, even though he spends the nights at his mother's house. If all other things are considered equal, the father would generally get to be considered the custodial parent. However, since Timmy is in school and his mother's address is registered for Timmy's schooling, days spent at the school are considered days spent with the mother. Assuming Timmy attends school for more than half of the year, his mother would still be considered the custodial parent, even though the father technically spends more time with him. Remarried parents and parents who are never married. With remarried parents, if a parent remarries, the new spouse's income is added to determine AGI for support and residency purposes, and their presence is considered the same as their spouse. Example, Timmy's parents divorced at the beginning of the year. His mother works as a maid, making little money in comparison to their father, or to his father, a construction foreman. For this example, he spends equal time with both parents. The tiebreaker rules for equal time spent generally default to the parent with the highest AGI. In this case, the father would be considered the custodial parent. However, if Timmy's mother remarried halfway through the year to someone whose income, when combined with hers, would exceed the father's income, she can claim Timmy because her new husband's income is considered her income as well. Additionally, if Timmy spent time with the new stepfather, that time would be the same as spending time with his mother. And then parents who were never married. Special rules for divorced or separated parents also apply to unmarried parents if they lived apart for at least the last 6 months of the year. And I'm going to turn it over to Derek for releasing exemptions.
All right. Oh, those prior slides contained a lot of information. I'm sure everybody's just kind of like running through scenarios in their head. That's typically how it works at this point. The thing to take away is that there exists a very serious and strict set of rules over who gets to claim in what circumstances because of the number of times this type of thing has been taken to court and battled out over the years, and anybody who's ever had any experience with family law knows it can get pretty nasty. So those things exist. If you need more information, we got links or references to different sections at the end of the presentation. The long and short of it is that you probably won't ever have to worry about those particular situations unless somebody comes in having a problem, or if the kid is being claimed by somebody else. I think the entire time, the last few years I've been doing this, I've very rarely seen more than a handful of issues where you ever needed to worry about it, and I've never had to worry about actually going on a day-by-day basis individually. So what the most important thing is when it comes to this is that a lot of this stuff is decided in advance, and that's what the releasing of the exemption is for. Per the rules regarding a divorced or separated parent, the custodial parent can release a claim to that exemption in basically one of two ways. One of them is a written declaration. Either condition uses the form of declaration to release the exemption. The custodial parent uses what's called a Form 8332 or a similar statement that contains the same information to make that written declaration that releases that support to the non-custodial parent. So the custodial parent basically has a decision to grant those exemptions to another individual. They can be released for a single year, a series of years, like alternating years or all the years, however it's written out. The statement, whether it is an 8332 or a written statement, as always needs to be attached to the non-custodial parent's return, even if it was submitted on earlier returns. So even if it doesn't change at all, if it's set in stone and the parents are perfectly happy with the way that it works out, non-custodial parent needs to attach this form every single time that he is going to claim this exemption. Now, for separation decrees that are after 1984 and before 2009, so the years 85 to 2008, you can use a written statement instead of an 8332, and it's got to have basically that the non-custodial parent can claim the child without regards to any condition, so it has to basically say he can claim it. It can't say he can claim it if he pays child support. It has to be unconditional. The custodial parent has to state that the custodial parent will not attempt to claim the child for the years that are outlined in the decree, and it has to specify which years can be claimed by the non-custodial parent. It needs to have a cover letter with the custodial parent's social security number, the number of pages in it, and a signature page that contains the custodial parent's signature to the return. Now, most of you guys won't have to worry about this because we're talking about a range of years, but if you do have somebody that had a divorce between 85 and 2008 and they're still dealing with that on their returns, you might come across it. Almost everybody else is using the Form 8332, which is from 2009 onward, because that's a standardized way to get this information to the IRS to let them know. Like I said, needs to be an 8332 if it's from 2009 onward. And as well, you might wonder as well, how is this going to get to the IRS? There is actually the ability in the software to attach a PDF of this form to the return and send it electronically. Historically, you would have had to have physically mailed it within 3 days of the return being accepted, and if for whatever reason the document upload doesn't work, that would still be the preferred method. But for the last couple of years, they have had a PDF upload feature that allows you in both the online and the physical software versions to attach this and send it to the IRS, so that way they have it. A custodial parent, by the way, can also revoke the released exemption for basically any reason using Part 3 of the 8332 and an attached revocation letter or statement to revoke the right for that non-custodial parent to claim that exemption. However, that needs to be done prior to the year that the revocation is to take place. So, if, for example, you have a breakdown in the custodial parent claiming relationship and the custodial parent wants to revoke that released exemption for the tax year 2015, they would have need to have done so last year in 2014, the year before. Otherwise, they can still claim it. You can't go 2/3 of the way through the year and say, yep, you're not going to take it for this year. It has to be done the year prior to the actual calendar year where you're going to revoke it. Okay? Now that we've gone through the age and the residency and talked about a bunch of different examples of how these rules can possibly be bent, next we get down to the support. In order to be considered a qualifying child outside of the relationship, age, and residency, they also have to pass a support test. At its very simplest, the child cannot provide more than half of their own support. That test is not the same, by the way, as the support test for the qualifying relative, which is the separate category, the second test that we were talking about earlier. And I just want to point out as well is that if you have any payments that are made by foster support, child placement agencies, or from state or local governments for supporting these foster children, those are not considered to be transited to another person. They are considered support from the agency or the government. So if you have the Smith family adopting Timmy, they adopt him for the last 5 months of the year, and they paid $4,000 out of their own pocket worth of support, but they received $6,000 from the state. The income from the state is considered provided by the state, and in this particular case, the child still qualifies because the child did not provide more than half of their own support. This is not, did you provide more than half of the support? It's, did the dependent provide half or more of their own support? And if not, then they pass the test. Scholarships that are received by a child that is considered a full-time student are not factored as support paid by the child, even though it's considered in their name. So for all of you parents out there or people that know who have college-age dependents on your return, if they're getting a scholarship, it's not going to suddenly count as them paying that money themselves and prevent them from being considered a qualifying child. So it just kind of disappears. Qualifying child also has to pass a joint return test, and generally speaking, a qualifying child is not going to be able to file their own joint return. They're not going to, be able to file their own married return with another individual. There is an exception, as there is to any one of these, that a qualifying child can file a joint return with their spouse and still be considered qualifying child if they file a return for only a refund of any withheld taxes, assuming that they meet all of the other tests for consideration as a qualifying child. So example number one, we got Timmy, age 18, his wife, age 17. They worked and they made about $2,000 during the year. They live with his mother. He meets all the other tests for being considered a qualifying child. He can file with his spouse, get a refund of any of those taxes paid, but if he attempts to claim any credit, any other tax benefit based on dependency, he's no longer considered. And so if he attempted to claim EIC for himself instead of just withheld taxes, he wouldn't pass the return test. In reality, he probably wouldn't be able to claim it anyway. The IRS would most likely contest it. But in the very rare case that I think I've ever seen one time of this happening out of the thousands of returns, they can't claim any benefit. They just basically get what they paid back. Second example, Annabelle, aged 18, has lived with her mother and father all year while her husband was deployed overseas with the armed forces. They file a joint return together. She's not considered a qualifying child. So if she's filing with her husband, even if he's overseas, otherwise she would pass the test. She files that joint return. She's definitely not going to be considered because she's not just doing it to claim a refund of those taxes paid. So in short form is that the residency, they need to live with the taxpayer for over half of the year. There are exceptions for your illness, your education, business, military, and so on, and that they essentially have to provide less than half of their own support. If those things are satisfied, then they are considered a qualifying child. Now we get into something called tiebreakers. Anybody who's ever done taxes before, it's filled out the form 8867, probably notes on the bottom of page 3 that there's a question that says, hey, did you talk about the tiebreaker rules if they apply? Well, these are what those rules are. Tiebreaker rules exist to essentially determine who gets to claim the child in the case of a qualifying child of more than one person. And this doesn't necessarily mean that more than one person is attempting to claim, it's just that the conditions surrounding the dependent allow potentially one or more people to claim it. So sometimes that person can be considered a qualifying child of more than one person, and with one notable exception that we're going to cover, only one individual can claim the benefit of the qualifying child on the return. They can claim that exemption and all the benefits that are connected to it. This is really important to mention because you cannot split the benefits outside of the one exception I mentioned for anybody that's on a return that you're claiming as a dependent. It's an all or nothing affair. The qualifying children of more than one person are subject to special tiebreaker rules that you can use to determine who actually gets to claim these benefits. And those rules are heavily in favor of the parents. So if you've ever done this before and you've got the Schedule EIC worksheet that's in the software, it has a section that says, can this person be claimed by anybody else other than the taxpayer? And that is essentially saying, does this dependent potentially qualify as the qualifying child of an additional person beyond this particular tax return? And these questions are supposed to be used to help determine if that is a yes and who gets to actually claim them. The preference between the contested claims for qualifying child automatically at first go to the parent. So if Timmy can be considered a qualifying child of both his mother and grandmother, and there's nothing else that basically gives him or gives the exemption over to anybody else, then that person, this Timmy, is going to be considered the qualifying child of his mother. If both of the parents are filing separately, and the child is considered the qualifying parent of both parents, or qualifying child of both parents equally, the consideration will then go down the chain to the parent who has spent the most time with the child, following the exact same rules we talked about for residency with children of divorced, separated, or unmarried parents. And if the time spent cannot be determined or is considered equal, then it will go to the exemption given to the parent with the highest AGI. So as another example, Timmy is considered the qualifying child of both his mother and father. He passes all the tests. His mother spent the most time with him, so he's considered her qualifying child, even though she makes less than the father. If for whatever reason you can't determine that time or it's equally divided, then the father would get it because he had the higher AGI in that situation. So first things first is the contest between a parent and a non-parent. Parent is first. If it goes down to parents and splitting it, it's going to be who spends the most time with him. If you can't figure that out, who has the most money on the return. If none of the potential claimants are the child's parents, then it will go to the first non-parent claimant with the highest AGI. If the claim is between parents and non-parents of the children, but the parents do not claim it at all, so like it's between the parents and somebody else and the parents basically back out of it, the exemption will pass to the non-parents if the AGI is higher than the parents' individual AGI. So that means that a parent cannot claim a child by choice if they decide, if mom and dad say, look, we want to give the exemption and the benefits to grandma or whomever, they still have to make less than this other person. Otherwise, they would have to claim it themselves. So as an example, to kind of help unmuddy that, if you get Timmy as the qualifying child of his biological parents and uncle, his biological parents are going through some hard times and they don't make very much money. They got $8,000 a year for the father, $6,000 for the mother. Timmy's uncle makes less money than his parents do combined. So Timmy's uncle makes $13,000 compared to their $14,000, but he has less expenses and he's more capable of satisfying the needs. So the parents say, you know what, we're not going to claim the exemption and we're going to pass him on to this uncle instead. So even though he makes less money, he makes more money individually than Timmy's mom or the father, and he can claim the exemption. Now, if the balance of Timmy's parents' finances were entirely in the father's hands, so instead Timmy's dad made $14,000 and mom made $0, the uncle could not claim him even if the parents agreed to it and all other tests were met. So parents decide to release the exemption to a third party. That person needs to make more money than either of the parent individually, I guess is the easiest way to say that gigantic, complicated paragraph. Split benefit, we've got a little breakdown here, this one special case exception before we move on to doing our first polling question, and that is no qualifying child, the benefits or any of the tax treatments that come from claiming them can be split among taxpayers, except if a taxpayer claims the exemption for the child in question, they're the only one who's able to claim the benefits unless the non-custodial parent agrees to or the non-custodial parent can claim the exemption and the child tax credit while the custodial parent can claim all the other benefits related to it. So when we were talking about releasing exemptions before, this exemption is only applicable in cases where the custodial parent agrees to release it and essentially follows the same rules that they have for non-custodial, divorced, separated, or unmarried parents. There are no other exceptions to this. So basically, mom, if she's got the kid, she can look at the dad and go, I'm going to give you the exemption, and you can claim the child tax credit, and he does that on his own return, and then she can claim the EIC on that return and, you know, the benefits like that. That's the only case that can happen. You can't do it voluntarily with anybody else. Just to let you know, it's very, very highly specific, follows the same rules that we mentioned earlier, and I think now is probably a good time to go into our first polling question. We've got a little bit of let me see here. Is Joe? Are you there?
Oh, sorry guys, I had two mute buttons hit there instead of one. I got the polling question. It should be popping up on your screen now. The question is, have you ever had a return held up or subject to IRS review because of an issue with the dependents on that return? And again, you know, we're not looking for a tricky answer here or anything. Make sure you answer this question. IRS likes to know that you guys are awake there on the other end. You know, while you guys are answering this, just a kind of an overwhelming answer to some questions that have been coming in here. Similarly to when we talk about earned income credit or any type of credits when it comes to children, it is not up to you, the tax preparer, to provide the burden of proof for these types of esoteric type of requirements. Your clients don't have to prove to you that little Timmy lived with them for 212 days versus not. That is entirely, that is very, very much detailed information that if you get some odd scenarios, I suggest you use these presentation slides as a resource to maybe help hash that out. But you know, you are not the honesty police. You know, you have to go with what your clients tell you and assume that they are telling you the truth. But you know, the overwhelming statement again is always, if you notice something that is inconsistent or incomplete in the information that your clients give you, you need to ask some more questions to make sure that you're getting the correct answers. But all right, looks like we got 90% of everybody has responded there to the polling question. I'll leave that up there for just another couple seconds here. Leave it up for 5, 4, 3, 2, 1. We'll go ahead and close that down and pop up there. Yeah, it looks like we're pretty well scattered across the board there. We got some guys that's your first time this season. I think what you will find is that the IRS, as their budgets are being cut annually here, as far as what we've seen for the past few years, they are getting away from the physical traditional audit that maybe was certainly more familiar or regular, I'd say 5 years ago plus, where you would physically see an IRS agent, gun and badge toting IRS revenue officer, come out, sit down with them, take a look at your return, and so on. And what they're doing now is called compliance audits or correspondence audits. And that is more the case of where they are going to send your client a letter and say, hey, we've got questions about little Timmy on your tax return. Please send me proof that he is disabled, or proof that he lives with you, or proof that he is not married, or whatever those issues might be. But that's really kind of the primary use of this information, is simply to educate you and give you some tools there in your quiver for when those kind of high-level type of questions come your way. But fantastic. I'll go ahead and hide that down, and Derek, I will let you continue on.
No problem. Qualifying relative is the next category, so all of that stuff was just the first of those 5 tests to be considered a dependent that I mentioned earlier. This one is the secondary category called the qualifying relative. A qualifying relative is, long and short, as a qualifying relative essentially gives you the exemption only and doesn't have any of the associated benefits, child tax credit, EIC, and so on. And in order to be considered a qualifying relative, they have to pass the not a qualifying child test. So in order to be considered a qualifying relative, the person must not be considered a qualifying child. So the age for it is irrelevant. They can be of any age. Qualifying relative is what you're going to be using for people who are not a qualifying child because they don't match those tests. You can use it for parents. You can even use it for people who are not technically related to you. So I'll go into a little bit more detail about that. But kidnapped qualifying relatives, they follow the same rules as a qualifying child, which ends on the date that they are determined to have passed away or the year that they turn 18. Dependents living in Mexico or Canada can be considered qualifying relatives if the support and gross income tests are passed. Then they don't qualify for qualifying child because they don't live with the parent technically. And this really only applies to residents of Mexico and Canada who do not live with U.S. citizens. There are technically 2 other exemptions or exceptions to the rule with dependent treatment for people from India and South Korea that I'm aware of, but I've never seen them actually come up, and they're highly specific and not worthy of discussion right now. But if you have any questions on those, feel free to let us know, and we can answer them at a later time. In order to be considered a qualifying relative, you have to first not be considered a qualifying child, and then next you have to be a member of the household or relationship. So in order to pass this test, the dependent must be either a member of the household for the entire year, all 12 months of the year, or they must be the child, a full step, foster, adopted, or their descendants, a sibling, full step, half, foster, adopted, or their descendants, mother or father, including step parents, grandparents, or another direct ancestor, but not your foster parents, an aunt or uncle, but their kids, your cousins, don't fit in that description, or be the son, daughter-in-law, father, mother-in-law, brother, sister-in-law. So that's a large range of different types of people. So like basically they got to either be not related, if they're not related to you, or they're not one of the accepted relations like a cousin. So if you have a boyfriend or a girlfriend or a cousin or something that doesn't fit into one of those age categories, they need to live with you the entire year, or they can be one of those categories. And any of those relationships, by the way, once they're established, they're not ended by death or divorce. So if you're claiming somebody who's related to you because your parents remarried and one of those parents passes away, you can still claim the other person. It's not like the death of an individual separates that link. Like once they're established, they last for life. The relationship can be traced through the spouse on a joint return. So once it's there, it's there. When you're talking about this as well, absences, once again, temporary absences do not count against whether a dependent is considered to have stayed with the taxpayer, so school, military, business, vacation, illness, and so on. And if a dependent that dies during the year or is born during the year and lives with the taxpayer for the rest of the year is considered to have lived with the taxpayer all year, and that counts even if the dependent had medical absences such as final medical treatments prior to death, postnatal hospital care, and so on. And I think I'm going to go ahead and I guess get this over to Richard. But before I do, one last thing is that to clarify this, member of the household of the entire year, or they have to be one of these relationships. Essentially, that's still following the 6 months or more rule. So if you are trying to claim a boyfriend or a girlfriend or a cousin as a qualifying relative, they need to live with you over for all 12 months of the year. Otherwise, they can just be over half. So if you have one of those categories and they're at least 6 months or more, they're good. Anybody else needs to be all 12 months. Okay, Richard, you want to go ahead?
Yep. Qualifying relative, starting with the gross income test. The dependent must not make more than the base exemption amount during the year. Last year it was $39.50. It generally goes up about $50 a year, and for 2015 it's going to be $4,000. Gross income defined. According to the Internal Revenue Code, the gross income is all income, no matter the source, in the form of money, property, and services that are not exempt from taxation. For example, this includes wages, self-employment income, income from rental or partnership, for pass-through income. Does not include wages typically considered untaxable. For example, combat pay, that would be one of them. Next slide goes to support test. In order for a dependent to pass this test, the taxpayer must pay more than half of the dependent's support. Support includes all income used to support the dependent, even if it is from usually non-taxable sources or is borrowed temporarily to pay support. At the very minimum, paying half the support means that the taxpayer must pay more for the support of a dependent than the dependent pays for themselves. For example, if a taxpayer's mother makes $2,000 and spends $1,500 of it during the year to pay rent, the taxpayer must spend more than that $1,500 to be considered as paying half of their support. Generally, on the next slide, support paid by any entity other than the taxpayer is not considered support paid by the taxpayer. So taxpayers receiving money from an adoption agency, for example, for supporting a dependent, or support from social services like food stamps or housing allowances, generally cannot consider such income as support they provided. Military personnel, however, who receive housing and food allowances from their pay are able to count such income as support for each allowance they specify. Joint payments received by a taxpayer, such as Social Security checks in both a wife and a husband's name, are generally split between the recipients equally, unless a reason can be provided otherwise. For example, a joint Social Security check for $5,000 spent on support would be split 50-50 between a husband and a wife as to who is considered to have spent it. Unless it is proven otherwise, they each are considered to have spent $2,500 on the dependent for that joint payment. When figuring on the next slide, total support, make sure to include all income spent on food, lodging, medical, dental care, clothing, education, recreation, transportation, and any other necessities. If the taxpayer owns the lodging or provides lodging support for free, the fair market value of the rental is counted against the dependent's own support for figuring total support. An example of this is Timmy owns a summer house on his property, hopefully in Hawaii, and he lets his mother live in rent-free. His mother receives only a small Social Security check and a small bit of interest. both of which she uses to pay utilities and for food. Any of the money that Timmy's mother spends on her support must be reduced by the fair rental value of the lodging in figuring her support. If the home would normally rent out for $6,000 a year, she would reduce her own total support by that figure. If Timmy manages to spend more on her support than she does for herself, and all other tests are passed, Timmy can claim his mother on his return as a qualifying relative. Now, when figuring total support, do not count the value of property provided equally to everyone in the household. Also include medical insurance premiums paid and not the benefits from the policy paid. Also, tuition assistance, GI Bill amounts for veterans are included in total support. Child and dependent care expenses are also included, but do not include income taxes paid, Social Security, Medicare taxes paid, life insurance premiums, funeral expenses, scholarships received by full-time students, or survivors and dependent educational assistance payments of the person who received them. Going on to the next page. Now, when multiple individuals provide support and no one person provides more than half of the support for a dependent, all persons providing support of at least 10% can decide amongst themselves who gets the claim, the exemption. This is called a multiple support agreement and is completed by all people who support the dependent via Form 2120, Multiple Support Declaration. Now, rules for divorced or separated taxpayers claiming a qualifying relative essentially follow the same rules as for a qualifying child. And with that, I'll let Derek continue.
All right. That's the thing to take away from this whole section over support is I mentioned that there was a difference between a qualifying child and a qualifying relative and that they were not the same. They look superficially the same, but the difference is on a qualifying relative, the taxpayer themselves has to actually pay more than half of the support. It's not just that the dependent pays less than 50% themselves. And the reason why that's important is because on a qualifying child, for instance, you might have a qualifying child who makes $10,000 or $15,000 a year working like a summer job or working on a university, but mom and dad are still paying all the tuition, they're still paying for all the food, they're still buying most of the clothes. So if you want to look at it, that particular dependent is paying less than half of their own support because mom and dad are paying more than half of it, and that's completely different than whether or not the taxpayer is physically paying in some form or another 50% or more of a qualifying relative's expenses directly. So it's, one of them is, does the dependent pay less than half, or does the taxpayer pay more than half themselves? And that's really the hinge point there. Now, when you're talking about these dependents and what happens, there are benefits that happen on the return. And when you claim a dependent on a return, they allow for a certain number of those, and the particular benefits that you're going to be able to get is the first thing is a dependent's personal exemption. That is a blanket sum of money that you don't pay taxes on. Okay, that sum right there is essentially tax-free money from ordinary income tax. As mentioned before, it's $4,000. So essentially every exemption gives you $4,000 of ordinary income that you are not paying taxes on. It also allows you to file the head of household status for taxpayers that are claiming a dependent if they fit the category or the qualifications to pick that status. Head of household is not as good, for instance, as married filing joint, but if you have an unmarried or a separated person who is considered unmarried, it gives them the opportunity to have a halfway point between single and married. It gives you the ability to claim the child and dependent care tax credit, so your daycare expenses or exclusion of benefits, which is on the following bullet point there. And then the two main ones, the child tax credit or the additional child tax credit and the earned income tax credit, which both of those combined are going to be the source mainly of the large refunds that you see in connection to taxpayers who are claiming dependents on their return. So the first things first, dependent's personal exemption is just $4,000 non-taxable income for ordinary income tax purposes. So that's on the second page of the 1040 That right there says, here you go, $4,000, don't pay ordinary income tax on it. So if you're looking at the back and you see your AGI get reduced by the deduction amount for the exemptions and your standard or itemized deductions, this is where that's going. That number is the same figure, by the way, as the income limitation for claiming dependents who are qualifying relatives, and that will reduce the taxable income. So the idea being is that $4,000 is the minimum amount of money the government considers necessary to live on a subsistence in this country. So if your qualifying relative makes more than that, technically they can't be considered a qualifying relative, and vice versa. Since they don't make that, since no dependent makes that, as far as they're concerned, you get that $4,000 per person. And for your average return, that can be a pretty significant amount of money, where you're looking at a tax-paying unit with a couple of children being able to claim, sometimes up to $20,000 or more income without paying any taxes on it. So when you hear somebody say claiming a dependent, that typically is generally a blanket term for referencing that exemption. And that is important because some of the benefits that do exist in the tax code do hinge around who actually has the exemption. So a custodial parent can claim the Schedule EIC credits, get that earned income credit, for instance, but they might not be able to claim some of the other benefits that are connected to the actual exemption itself, like any of your education credits or child tax credit and so on. Now, this one right here is a significant problem for a lot of people who've never done taxes before, who have been through less than a season or even only been one, and that's the head of household filing status. There's a lot of confusion over what the head of household status is. And what the head of household status is a special filing status that is given to taxpayers that claim a qualifying dependent and who are considered unmarried at the close of the tax year. Considered unmarried is a defined legal term in this regard. And what this does is it increases the standard deduction from the $6,300 that you get at single to $9,250 for tax year 2015. In addition, it lowers your tax rates by spreading out the income bands, and it helps in the calculations for certain types of credits and income exclusions and so on. So in order to be considered unmarried at the close of the tax year, it means that a taxpayer must be single at the end of the year, legally separated from a spouse by a divorce or a separate maintenance decree, or married but not living together for the last 6 months of the year. And that's the one right there that is the most cause of confusion. Typically speaking, if you have a married couple, it is better for them to file jointly in almost every single case. However, if you do have a married couple and they're not wanting to do the married filing separate because it just disqualifies you from almost everything positive in regards to a tax return, as long as you did not live together for the last 6 months of the year, then you are considered unmarried and you can claim head of household status if you have that qualifying child instead. And what that means is that you need to be able to claim your own personal exemption, and you also have to pay over half the cost of keeping up your home. So if your split couple, for instance, did not live with her ex-husband for the last 6 months of the year, but she was instead living with somebody else and they paid half of the bills or more, then she technically still doesn't qualify and wouldn't be able to claim that dependent. Apologies for that little pop-up there. Let's see here. Moving on to the next thing, I think is what we're going to do is talk about the child and dependent care credit. This one right here is also another source of confusion, specifically because people will pump numbers into it and they won't actually see any benefit on the return. And the reason why is what this does is it allows a credit for expenses to obtain dependent care services, and it's received as a credit from 35 to 20% of the expenses paid based upon the income of the people, and that's the hinge point. So taxpayers can claim these expenses. They can spend up to $3,000 for one dependent or $6,000 for more than one dependent in regards to those expenses that are multiplied by that percentage. And like most other benefits, it's not related to people who are able to file separately unless they are considered unmarried, like we talked about just a second ago. They can still take the exclusion for the dependent care benefits if they are paying those through their wages, and I believe it's box 10 on the Form W-2, if they would otherwise be considered qualified to take that particular credit. And the payments, and this is the part that causes the concern when people put these numbers in the form, this 2441, they don't see a benefit. It's because the payments need to be made so that way the taxpayer and their spouse, if filing joint, and their spouse, not or, and can find work or work, since it is based upon earned income. So a non-working spouse would just disqualify the whole credit because there was no earned income received during the year. The payments, by the way, also can't be made to a spouse, a parent of the dependent, a dependent themselves, or any of the other taxpayers' children under the age of 19, whether or not they were considered a dependent. So you can't, for instance, pay your own children to watch the kids and then try and claim a credit for it. I have actually seen that attempted. The IRS does not like it. And the important thing to keep away is that earned income right there. Is that I have seen far too many people where they have a stay-at-home mom, she has absolutely no income, they do pay a babysitter, no earned income on one of the taxpayers or on the other taxpayer, or if all the income is unearned, we'll disqualify you from this credit. So if you ever see that happen, that's probably, or on a return, that's probably the case. And I think I'm going to go ahead and pass this over to Richard to give us a little bit of discussion on the next few topics before we move into our polling question after that.
All right, we have two left, child tax credit and additional child tax credit, followed by exclusion for dependent care benefits. The first one, child tax credit, is a non-refundable credit. Additional child tax credit is a refundable credit. The child tax credit reduces the amount of tax owed by up to $1,000 per qualifying dependent. Generally, this is limited to each dependent considered a qualifying child, subject to one additional rule. The dependent must be under the age of 17 at the end of the tax year. If the credit reduces taxes owed and doesn't use the full credit to do so, the taxpayer may be able to receive the difference via a Form 8812, the additional child tax credit. Essentially, it allows the unused portion of the credit to be considered refundable, as in it becomes extra money received by the taxpayer. This credit is phased out at higher income levels, $110,000 for joint filers, $55,000 for married filing separately, and $75,000 for everybody else. This credit is often the only one available to resident and non-resident aliens filing a return. On the next slide, we continue with exclusion for dependent care benefits. Taxpayers who receive dependent care benefits from their employers may be able to exclude them from wages, even if they normally can't take the credit. This is also done on Form 2441, just like the credit is. Employers will generally list the benefits in box 10 of their W-2, so make sure they haven't been taken from wages reported when calculating the exclusion. And now immediately on the tax software, on box 10, if you put an amount in there, it will automatically bring up a 2441 on the TaxWise software. And if you don't fill anything into the 2441, you will get a warning before you create that e-file, which won't prevent you from creating the e-file, but it does give you the warning. Self-employed taxpayers under a qualified dependent care benefit plan do not exclude from wages like a traditional employee. Instead, they deduct the expenses on their Schedule C, their Schedule E, or Schedule F. Schedule E is for rents and for any rental properties, and Schedule F are for farms, and complete the Form 2441. Taxpayers can exclude or deduct the smaller of one of these four: qualified expenses paid during the year, benefits received during the year, earned income or spouse's earned income, whichever is less, and or $5,000, $2,500 if married filing separately. And with that, I'll let Derek talk about earned income credit.
Yeah, before we go into that and the polling question, I did see a couple of questions pop up on the side that I wanted to address before we got to the end. And the first one is that in regards to the credit, yes, there does need to be earned income for both. I saw some confusion over that. So if you do have any one of the two, if you have two parents claiming a kid, trying to get the dependent care benefits, and one of them doesn't have any earned income, then yes, the credit will be excluded, so you will need it. And then there's a little bit of confusion. I'm not talking about the ability to claim a dependent, period. You can definitely claim a dependent even if one of the spouses does not work. I'm only was specifically addressing the dependent care benefit when I'm talking about the income versus non-income category. So if you are paying a daycare center and you're trying to claim that for a benefit on the tax return, every taxpayer, either the taxpayer or the taxpayer and their spouse, needs to have that earned income. So I apologize for any any confusion in there, but only speaking about the credit for that. And I think now is probably a good time to get that second polling question in there.
Sounds great, Derek. I'll go ahead and get her popped up here. You guys should notice now you got the question on your screen again. There is no bad answer or wrong answer here other than not answering. The question is, do many of your clients claim any of the credits, whether it be earned income credit, child tax credit, dependent care credits, or so on for their dependents? And again, just take your pick of those. Obviously I'm interested in seeing what you guys plug in there. But we'll leave that up here for about a minute, give everybody an opportunity to go ahead and plug that in. Looks like we got just about everybody that's answered that one. We'll leave it up here for about another 10 seconds. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. And we'll go ahead and close that down, and I'll let you guys see what everybody has plugged in there for their answers. It looks like, honestly, just about everybody really should see clients in there with dependents with some type of credits on there. Even if you're dealing with a higher income demographic or a traditional base there for your clients, there are a lot of those credits that come along that are still available a pretty good ways up the income ladder. But for those of you that it's your first tax season on here, really these credits that we're talking about now, go just hand in hand or really just are in lockstep with dependents and the benefits that they provide. We have an entire webinar dedicated just to the earned income tax credit because it is such a ripe and just heavy, valuable credit to your clients. And I'd suggest you take a look at that if you're going to be filing returns with dependents that might be jumping on that earned income credit bandwagon. It's an excellent credit. Dramatically increases, blue collar, middle to low income earners tax refunds. But you want to make sure that you're operating with due diligence. You want to make sure you're asking the right questions so that you have your own butt covered. You've got your office covered when it comes to any type of preparer due diligence requirements or audits that might come up. But I'll go ahead and hide that down there. And Derek, I'll let you continue on. Thank you.
No problem. Pretty much the rest of this presentation and probably the single largest bulk of information outside of just the rules that we covered is going to be over the earned income credit, because the earned income credit is, just to be completely honest with you, probably the thing a lot of your clients are going to come in to try and claim. And a little bit of background on it is that the IRS, for instance, last year paid out $66.27 billion for EITC claims. Okay, that is a lot of money. 66.27 billion. That's up every single year, and that's just a lot of money that's going out there. And as of right now, even with improvements that they've made, the estimated current error or fraud rate is somewhere right around 22 to 26%, which means that it's worth between 14.6 and 17.2 billion dollars annually that is paid out incorrectly. There are some estimates that have that number much higher, going up to as high as $23 billion. It is the largest refundable credit that is available on the U.S. tax return. And for example, the average claim for EITC last year was $2,345 on top of the return. And as a result of its size, it is the third largest social welfare program in the United States. And the earned income tax credit, it's technically EITC. It's usually just called EIC in the industry. It's easier to say. It's usually the single largest refundable tax credit that's available to the majority of taxpayers, and it is the source of most of those giant refunds that you're going to see. What it's intended to do is to give boosts to taxpayers in the low or moderate income bracket, and as a result, the amount of the credit depends upon the taxpayer's filing status, their income level, and the number of eligible dependents. It is based on a bell curve, meaning that there is a middle range or a sweet spot of income for each filing status and for each number of dependents in order to get the largest amount. At really low levels, the credit is small. As the income increases, it rises and rises and rises until it hits a point in the middle, and then after that point it just starts to drop. So for example, a taxpayer with a dependent who makes $5,000 a year in income will receive less of a credit than if she made 14 grand, but after that middle range is met, the more income they make, the lower it'll be. So same taxpayer making $25,000 will probably have about the same amount of credit as if they made $5,000. It's a boost between a middle range depending upon your filing status, income, and the number of kids. It's primarily used with taxpayers claiming dependents. However, there is also the ability to have this credit applied to a taxpayer and their spouse if they're married and filing jointly, as long as they have low income and no dependents. So you do have the ability to get self-only EIC, but the income ranges are just much smaller. So a single taxpayer with no children can make a maximum of $503 of the earned income credit if their qualified earned income is within that maximum credit range. If they make more or less than that, the credit is of course going to drop, and that range changes depending upon their circumstances. So and just like anything else, by the way, money from EIC, like any tax credit, the first thing it's going to do is to go to reduce the taxes that are already owed before any amount is refunded. And that can be especially important for self-employed taxpayers because they can see some of their EIC allotment reduced by the unpaid self-employment taxes, so only after those owed taxes are paid can any amount of the credit be refunded at all. And taxpayers, by the way, can and do get denied or continuously denied after the fact this credit. And that self-employment mention that I'm bringing up is important because you might have two people, the same exact scenario. They're the same age, they have the same number of children, they make the same amount of money. If the self-employed person did not make estimated payments, then that self-employment tax that they didn't pay during the year is going to come out of their refund. So you'll have two different refunds for otherwise identical tax situations. In order to be qualified for earned income credit, the taxpayers must meet all of the following rules. The taxpayer, the spouse, and any of the people that are listed on the Schedule EIC, which is the form that's used, they need to have a valid Social Security number. A valid Social Security number is a Social Security number that is valid for work purposes in the United States, regardless of whether or not that person is physically capable of working. Like you're not going to have an infant going to work, for instance, but at some point that Social Security number is going to grant them the ability to work and pay into the Social Security Fund. There must be earned income on the return. This one is a really big source of confusion. It needs to be earned income, either from the taxpayer or the spouse. It doesn't matter who, as long as that earned income is on there. That's your wages, your salaries, your tips, taxable employee pay, union strike benefits, long-term disability payments that are earned before retirement age from an employment in the past, your net self-employment income from operating a business or working for a religious organization, or gross income received as a statutory employee. What it does not include, pay that you get if you're an inmate in a penal institution, interest, dividends, retirement income, Social Security payments, unemployment, alimony, child support, and even though it's not on there, it also throw in passive activity from things like Schedules K-1 or partnerships, and in some cases rental income if it's not considered an active business. There is also the ability for a taxpayer to elect to include non-taxable combat pay as earned income at their choosing. This is one of the many type of little tax laws that benefit veterans that regular people don't have. And normally your non-taxable combat pay is not included, but maybe you want to hit that sweet spot. You can include it in there voluntarily if you choose to do so. It just has to be the whole amount. You can't choose part of it and leave the rest outside of the calculation. And when I say elect the non-taxable combat pay as earned income, that doesn't mean make your non-taxable pay taxable income. It's only going towards the EIC calculation when I mention that. Taxpayer cannot file married filing separately. Just one of the many reasons I mentioned before about the considered unmarried thing, that if you do have somebody who's trying to get EIC and they are married or they're in the the middle of a split, you want to try and get confirmation that they didn't live with that person for the last 6 months of the year, not even a single night. Can't have the estranged husband spend the night for Thanksgiving, for instance. It has to be completely separate for 6 months of the year. So if you can try to avoid that married filing separately status, because it will disqualify them from this. Taxpayer needs to be a U.S. citizen or a resident alien the entire year, or a non-resident alien that is married to a U.S. citizen or resident alien and filing a joint return. Taxpayers cannot claim EIC if they're the qualifying child of another person. So you can't have, for instance, a person with their own child claiming EIC for that child if they themselves are also the qualifying child of a different taxpayer. So that prevents nested EIC claims from going up the chain with a bunch of people claiming each other down the line. The taxpayer cannot file Form 2555 or 2555EZ, which is for the exclusion of foreign earned income, or the foreign housing exclusion. Can't have that. And the taxpayer themselves needs to meet one of the following. They need to have a qualifying child. If they don't have a qualifying child, then they need to be over the age of 25 at the end of the tax year, live in the United States for more than half of the year, and not qualify as a dependent of another person. So if you do have somebody who's getting EIC for themselves and they don't have children, the biggest thing to take away there is that they have to be over 25. I've seen several people wonder why they're not getting it, even though they fit the age category and the income category, and it's because they're under 25. If a taxpayer qualifies for EIC, and this is a really interesting point here, if they qualify for EIC on their return, by law, technically they have to file a return with the IRS, even if they don't owe tax, even if they're not otherwise required to file. If you're familiar with the concept of filing requirements, you're aware that under a certain amount of income, typically the average person does not have to file a return. If you qualify for EIC by the conditions of your existence during the tax year, technically speaking, you're supposed to file so that EIC can be allocated by statute. Taxpayer fraud. I mentioned it before with EIC. It is a very, very high number. We're looking at somewhere around 1 out of every $3. Like the ratio drops. The IRS themselves are saying it's between 22 and 26. Either way, 1 out of every 3, 1 out of every 4. That's potentially up to $20 billion a year in fraudulent EIC money. That is a very large number. That is actually larger than the military budgets of most of the countries on the planet. So this is a very big concern as far as the IRS is concerned. The IRS can and do withhold EIC on returns for suspicious returns, even perfectly viable returns at random, requesting further information on those people on the Schedule A EIC before releasing the money. There are several people, especially if you've done at least a tax season and you've had a couple returns under your belt, they've probably seen it. You'll get a check or you'll get a bank product, you'll get money. The taxpayer will have money, but it won't be enough, and you're wondering what's going on. They go into the "Where's my refund" tool, and suddenly they see the notice at the bottom. It says, we have sent mail to your address. Please respond. Okay, and a lot of times what they're going to do is they're going to say, look, this person, we want proof. We want you to respond to these letters and let us know that it's okay to claim it. And this is this is done sometimes at random. So it's actually quite common, and it is a nuisance. But it's not something to panic over unless you become aware or were complicit in fraud of some type occurring. Taxpayers, by the way, who file EIC claims recklessly and they're penalized for it, they claim it, especially if they get the money and it finds out that it was reckless or whatever, they can be banned from claiming EIC for 2 years from the date the decision was made to penalize it, or the date the return is filed, whichever is later. It's the IRS's discretion. If they find out that the EIC claim is deliberately fraudulent, not just negligent, not just I didn't understand the rules, but actually a conscious attempt to defraud the government, then the taxpayer will be prevented from filing for 10 years, which means that if you have a decision to make an EIC claim that's fraudulent now, and you get hit with it, and they hit you with that 10-year penalty, maybe 5 years down the road, you're a changed person, and you go to claim your own kids legitimately, they can still prevent you and just basically say, sorry, you should have followed the rules the first time. And those right there, people who have those EIC problems like that sometimes get rejected notices on the reject codes that say this person is just flat out completely prevented from claiming EIC, and that happens. Electronically returns that are or electronically filed returns claiming EIC by taxpayers who have been denied in the past, by the way, will be flagged and they will be rejected by the filing center unless a Form 8862 is attached to it. That form allows taxpayers to claim dependents after denial in certain circumstances. So as long as they're not actively prevented, so, maybe you have somebody, they file recklessly, they kind of a little fast and loose with their numbers, they get hit with a 2-year penalty, and they get back to year 3. Now they can claim EIC again. If they've had it denied in the past, they're going to get a flag on their return, and they'll need that 8862. In the software, it's actually a relatively simple choice of selecting 1 or 2 boxes or going through and actually listing the dates that the dependents were listed on there. There are different ways to fill that particular form out, but people who have been flagged in the past, if they don't have that form, it's going to get rejected, and it will stay rejected until that problem is fixed. That's also the reason why on the EIC worksheet that's inside most tax software, there is a question that says, has the taxpayer been denied in the past for EIC? And answering yes to that will add the 8862 by default and make it required, so that way you don't accidentally miss it and cause any sort of delay in the processing of your client's refunds. Going into the actual credits themselves, this slide is pretty much pulled from the webinar that we did recently over the tax law updates for the coming year. These numbers can change. They are current as of right now, and they probably will remain current. And what it's basically showing you is the maximum amount of credit that you're going to be able to get for having 1, 2, 3 or more qualifying children, or none. And then you can see over on the right-hand side that goes all the way up to as high as $6,242. And then immediately to the left of that is the AGI that is being used for the max credit. That's the sweet spot that the amount of income has to be on the return in order to get that credit. These figures come from what's called the Publication 596. It's almost always one of the last forms the IRS fills out. I don't know if that's a conscious attempt to try and prevent fraud in the beginning or just because they spend so much time working on it, but those numbers may change, but Publication 596 is where they're going to be located, and as soon as that becomes public knowledge, we're going to have a version of that up on our website. And in addition to that, the phase-out ranges are listed below. Married filing joint has a higher phase-out range from where the credit starts to actually disappear and finally go away. So you can see, for instance, a single person with 1 qualifying child loses EIC at $39,131, and a married filing joint would lose the EIC once they hit $44,651. And as an example, what I'm talking about with that sweet spot is it basically looks like that. You have a rise up to a certain point. If your income's between the ranges, it caps, and then it starts to drop. Just a little visual representation for what I'm talking about when I say bell curve. It's not a perfect bell curve. That's not even 100% accurate to the actual shape that it would be there, but it's essentially following the same principle. It goes up, flattens out, and then goes away between those ranges. When we're talking about preparers and preparing these returns, because of the rate of fraud, the IRS doesn't just have their eye on the taxpayer, they have their eyes on you as well. Different people have different requirements for the amount of rules that they're supposed to be following for different retention purposes, credentialed versus non-credentialed. But what you are going to be doing is note that everybody who's a tax preparer is ethically bound to ask certain appropriate questions to taxpayers regarding the information on the return. That's actually going to be the focus of the webinar that we're doing in a couple of weeks over due diligence and EIC, and that also forms the core of what's known as due diligence. And it's essentially a check on the preparer to make sure that they do proper inquiries about the information that the taxpayers provide on the return. So in regards to the return itself, that's done through a Form 8867. It's a 4-page form. It's included on every single return by default in all of the templates and pretty much every version of the software you'll ever find. And taxpayers should not aid a tax preparers should not aid a taxpayer in filing a fraudulent return for EIC. You want to pay close attention as you're doing these. I know it sounds like a doom and gloom scenario, but I'm really trying to help you guys out. So even if it just seems kind of like a fear-mongering or scare tactic, you might be right. Maybe it's not going to come up to you, but if the IRS catches wind that there's something happening on a return that they don't like, they can implement some severe penalties. Oftentimes, a taxpayer, for instance, is not going to understand that EIC is based on earned income. They might wonder why they're not getting it. Maybe they have all their money in Social Security, or maybe they had a bad year and they were on unemployment all year, and they're wondering why their refund is a couple $1,000s less than it was in the prior year. So you want to keep those types of things in mind. Self-employment taxes, you want to make sure that they're aware of the situation so that way you're not, actively aiding and abetting and having a fraudulent claim put on there, because the IRS really, really, really likes to prevent that from happening.
Hey, Derek, before you go on, I'd like to maybe chime in a little bit as what you're saying there on EIC due diligence and kind of preparers' responsibilities. I have had the privilege of working with some of our offices that have had to go through earned income credit audits, and over the years, I kind of see what the IRS is looking for, or I guess what triggers them to act. And what I've been noticing over this summer in particular is that the IRS is really looking at income, specifically self-employment income. And Derek, would you jump back a slide or two to that bell curve that you had up there? And perfect. And what I'm seeing is that the offices that have had returns audited, or a segment of returns audited, really what they all have in common is they have self-employment income or self-employment loss on a return that would actually target or land the return at the highest possible peak of the earned income credit scale. So it is increasing their income to get to the very peak of this credit curve that we're looking at, or they are putting loss on a Schedule C for self-employment to bring that income back down into the peak of that credit curve. So as Derek is talking to you, and Richard's talking as well about due diligence, what your number one job is as a tax preparer and a tax office owner is to not encourage or create or allow for an environment of fraud. And that means that you are not saying, oh, well, your return would be a lot better if you had your own self-employed business and you had operated at a loss this year. Or are you sure you didn't have any other income out there? If you did, your refund would be X. It is important that, like I said before, you take your client at their word and assume that they're telling you the truth, but you don't want to be leading a customer. You don't want to be throwing out these, honestly fraudulent type of tactics to increase the refund. And we've seen several offices that have gone through that audit process this year, and every one of them that I've seen has been related to income creation or loss creation based on self-employment that is not verifiable. So just wanted to chime in there since I've had a few of those conversations here recently. Derek, thanks a lot.
No problem, no problem. It is definitely something we have seen, and that actually ties perfectly into this particular slide that I was getting to, is that they've been sending review letters to taxpayers at random and tax preparers, which I'll talk about those letters coming up too, kind of requesting information on dependents or income, as he's mentioned right there. Some of it's random. Their data tracking has begun to establish patterns. So they've really only been able to really increase their technology budget after the creation of the modern e-file system a few years back. So it's about 3 or 4 years into it. They've got some clear patterns set, and it's making them a lot more efficient at identifying problems and getting to them specifically instead of casting a wide net. They're capable of putting to use the fishing analogy, they put the worm on the hook and toss it to the right fish. They don't just throw a net, hope that they catch the right ones in there, and darn the consequences if anybody else gets caught in the dragnet. They have been tracking preparers specifically as well to try to isolate it, because a lot of times preparers will do it without the knowledge of the actual taxpayers. This is a very common thing in large cities. Almost every single year following tax season, there's some news story about a certain group of individuals that were filing returns for millions of dollars accumulative, and the IRS will basically take them to court and throw them in jail. Sometimes I've seen sentences over 200 years collectively for some of this stuff, because they want to really take it to these people that are not supposed to be doing it. Okay, and the way that you get out of that, the way you avoid any of this problem beyond not facilitating anything directly, is to keep records. The response is two-stage that they do, and it starts with a warning letter, and then it follows potentially by an audit of files. So the first thing out, they send the letters 5025, 5025C, 5025Q. That's the you may have prepared inaccurate returns. That's the warning letter. That says, look, a high number of people that you filed had their EIC taken away. I don't know if you're part of it, but I just want you to keep in mind that you might be doing this wrong, so check it out. That's what that letter means. The 5138 is the on the IRS's radar letter. It identifies that you have an upcoming EITC client audit. And the reason why that's important, because when you get down to the penalties, assuming that they're, like, we're just talking about the financial penalties, not any criminal ones that they could potentially levy, is that you have a $500 per return penalty for failure to adhere to the due diligence requirements. So you don't have documents you need, you're sloppy with the record keeping, you transpose numbers wrong, $500 per return that they identify. If you rely on an unreasonable position, as in you look at what you put on the return and you could basically not be counted to have a reasonable basis for assuming that that's accurate, it's a minimum of $1,000. If they find out that you intentionally disregard it, that you fraudulent, you deliberately do it, we're talking a minimum of $5,000. And most of these are a minimum number or half of the income that you derived from the activity as a penalty on top of anything else. So, I mean, I've seen some of the restitution amounts for these cases that go into the millions because they'll be like big data centers. Now, this is not something most of you are going to have to worry about. If you do enough returns, inevitably it's a consideration that maybe somebody's going to have it denied, maybe somebody lied to you, and we'll talk about the retention in a second, because what's really going on, we sort of covered it already in the sense that you've got your income, you've got your withholding, etc., that the EIC, the extra amount of withholding and the extra credits over the taxes that you owe is what's going to actually equal that refund. And people are coming up with stuff to try and make this green chunk bigger than what it should be. So to keep up with that due diligence, as a short summary of the future webinar that we're doing in the coming weeks, if you ask a question, write it and the answer to it down, whether that's on a sheet of paper, whether that's in a diary feature. If you're using the desktop software, you can hit the F7 key on the top of your keyboard and type it into the notes there. If you're using the online software, there's a diary filter feature built right into the buttons on the top. Type these questions down, keep the answer to them, so that way you have a record of it. That way when they sign that return, they agree to your record of events. And that's really the thing. It's not a he said, she said, because if you write these down and they go on the return for official records, when they sign off on it, they're agreeing to the contents, they agree to the fact that you asked those questions and got those answers from them, and that at least gives you a paper trail. Okay, and if you have a different software, you're not coming from it from here, I'm sure every one of these softwares has probably got a diary feature, and if not, a sheet of notepad or a sheet of note paper or something on the side will definitely help you out. And if you do rely on a document of some kind, keep a copy. I actually recommend to just copy everything that they have when they come in, as long as you've determined it's for tax purposes. Go through the stack, find out what's actually going to matter. If it doesn't matter, you can put it off to the side, like your grocery bill, not going to matter. But if you've got tax papers, just keep a copy of all of it, and that way it's done, it's out of the way. It's before you even type a single letter into the software. You have a record of it, you have a copy of it, you don't need to worry, you won't forget anything. It's right there. And the documentation is not always required, but it is highly advised to use it. The IRS is not going to have you send this stuff in with the return, okay? This is required for you to keep on your own record. It's very likely that the vast majority of the documents that you keep will never be looked at by another living soul until the end of time. But if they ask for it, you have to have it. So if you are in a low income, a high crime, a really highly urbanized area, if the return seems fishy or they seem like they're maybe leading you with certain questions, or if it seems suspicious, like try and make sure to keep that on hand, maybe even save it in a location or physically or on your computer where it's easier to access than the others. Places that have high rates of ID theft might get asked for documentation more, or have more review letters. Border areas, the entirety of Florida, I'm not joking by the way, pretty much the entirety of Florida is considered an ID theft risk. There is a requirement for you to have a copy of the 8867 form, the prepare due diligence forms that we've talked about a couple of times. Those are automatically included in the software. So you don't need to really worry so much about having that because they're already part of the returns that you already have access to, but feel free to keep a copy of them elsewhere if you really want to. And if the IRS does an audit for EIC purposes, they may potentially go through every return that was filed in a date range, okay, that they're looking into. They're not doing that as much anymore because they usually have a list of returns at this point. As Joe mentioned before, that's often connected to that, self-employment claim. In the past, they used to literally come in and say, I want every return between this date and this date now. When you're talking about this right here, they might actually come in with a list and say, I need to see these specific people because their data tracking is only getting better. And then the last slide before we get on to the dependent resources and moving into the questions, the Obamacare and dependents, just as a little side note for the upcoming year, the flat penalty amount for Obamacare is halved for every month. Dependent is under the age of 18, which comes out to $162.50 a year. So you're looking at $325 per person flat penalty amount, and that's $162.50 a year that you could have potentially maximum for a dependent, which is a little over $13.50 a month. The penalty for not having coverage. A dependent's income, by the way, can count into the taxpayer's income for healthcare purposes, even if it's not for health or even if it's not for tax purposes. So if you've attended any of our PPACA Obamacare webinars in the past, basically a dependent's income, if they're required to file, is included in the household income feature to determine rates for the credit for the premium tax credit or whether they're exempt or not. Taxpayer does have option to include investment income for dependents on the return taxed at his or her own rate through the Form 8814. And for healthcare purposes, by the way, when you're talking about the household income, all income earned by the taxpayer, including the normally non-taxable Social Security, Tier 1 railroad retirement benefits, tax-exempt interest income, income of dependents claimed on the return and required to file, they all go into that household income calculation. Now, if you're wanting more information, Publication 501 covers your exemptions, your standard deductions, and your filing information. That gives you a comprehensive set of rules regarding the exemptions, deductions, and filing statuses. It has not been finalized for next year, but the rules behind it, if not the numbers, but the rules themselves should have remained the same from last year to now, so you could go check it out at this moment. Publication 503 is over your child and dependent care expenses. That'll pretty much handle in its entirety most of the stuff that can go on the Form 2441. Publication 596 is the earned income credit. I mentioned that's one of the last ones that they'll get to, and when that one gets finalized, that will show you the amount of EIC for each band of income, for each filing status, all the way from beginning to end of the credit. It breaks it down line by line in a gigantic series of charts at the end of it. The Publication 17 is a tax guide for individuals. If you've done any trainings with Richard recently, or her new partner, or have done taxes for a while, you probably know what it is. It's just the overall tax guide. It kind of covers everything that you're going to be dealing with in most of your individual tax returns. And then the Publication 3 Armed Forces Tax Guide has some of those specific pieces of information. It was page 17 last year, talking about combat pay election rules, and then scattered throughout are a couple of special case scenarios that might involve dependents and your military members. And at this point, we're going to go ahead and open the floor to questions. So if you haven't done so already and you wish to, feel free to go over to the right-hand side of your screen and type them out, and we'll see what we can do to get them answered.
All right. Hey, thanks a lot, Derek. Nice work. I'll go ahead and start burning through a few of the questions that have already came in on my question panel here that I've answered privately as we've gone through. First one, I had a question came in about how can I claim dependents that live outside of the country? And we touched on that a little bit earlier. And really what you're talking about are two different scenarios. If you are dealing with an expatriate, a U.S. national, there's going to be some time limits as far as when they can be out of the country, how long, and how that will qualify. But the question here that was posed was relating to non-U.S. citizens. And basically, during NAFTA, North American Free Trade Agreement, they set up a framework where non-U.S. citizens in Mexico or Canada can actually get what's called an I-10 number, an individual taxpayer identification number. Excuse me. And if they have a tax purpose for filing a U.S. return, such as being in the country and having earnings, they can claim dependents that are living outside of our borders in those countries. You would need to get an I-10 number for those dependents that we would be claiming there as well. So we do have a pretty nice presentation that covers I-10s and immigrant tax filing solutions and issues that come up. I'd suggest taking a look at that for some real detailed information on I-10s and dependents with I-10s as well. I got another question here as far as how do you maintain proof for your client that their dependents are disabled? And really it goes back to my statement as far as you are not the honesty police. You need to be able to identify what does being disabled mean. Are they permanently or totally disabled? Are they unable to work? And if your clients can answer those questions accordingly, then put them on the return as being disabled. You do not have to have a doctor's note in front of you, but you can, if they do bring that to you, put it in their file, store it for at least 3 years per IRS regs, 5 years if it's a bank product return. But again, you're not the honesty police. You don't need to do any type of medical examination on these dependents. Take your clients at their word unless you are recognizing that there is incomplete, inconsistent, or inaccurate information being given to you. Those are the all important 3 I's when it comes to due diligence. So bear those in mind, and that'll keep you out of trouble. All right, got another question here. Can you give me an EIC due diligence example when you would ask for more information? Okay, sure. So an example of let's say inconsistent or incomplete information. For me, that would be, I think I usually throw out the example on our earned income credit webinar as far as if you are filing taxes for a 19-year-old single parent who tells you that they are taking care of their 15-year-old child. That is inconsistent with my normal frame of reference as far as what a parent and a child age gap would be. Maybe they adopted that child and it's perfectly normal and legitimate. Fine, that's wonderful. But having a child when you're 4 years old is probably not common at all. So that would cause me to ask some additional questions there. I had another question as far as what about same-sex couples? Can they claim dependents? Absolutely. Ever since the Defense of Marriage Act came out and has it's a federal passing federal legislation that basically means that any same-sex couple that is married in a state that I guess gives out legal marriage status, they can file a tax return and have the exact same benefits and credits allowable to a traditional married couple. So I hope that helps out there. Derek, I think that's most of them that have came through on my side. Have you got any questions there on your panel that you want to add in there before we sign off for the evening?
Sure. What I'm sitting there looking at is someone's talking about clients staying with somewhere then moving. I guess just kind of curious about the residency and things like that. It's not really a question of which address was used. Like a person can have their kids and move literally every single month of the year. It's really hinged upon not a specific address per person per year. It's not like there's a limit on the number of homes you can live in. It's really dependent upon the tests. Did they live with the taxpayer? Did the taxpayer pay more than half of the support? Are all the other tests like the relationship and the age and everything else met? If that's yes to all of them, then it doesn't matter if they spent 6 months one place and moved somewhere else for 6 months, or if they moved every month or every week or even every day. As long as they have a defined tax home and they all live together as a unit and they're paying more than half the cost and all the other tests, it doesn't matter. It's not tied to a specific geographical address. It's the tests that have to be made. There are people that have transient housing situations or move a lot. That doesn't matter. That has no impact whatsoever on the end result. I think that's about all that I have that's popping in that haven't already been answered, actually.
Yeah, I don't really have anything, but I will stress that keep those records. Use your due diligence. Ask those questions. Document those questions. That's what the diary's for on our tax software. And you just can't do that enough. Whatever questions you ask, whatever answers they give you, make sure you just write that down.
Yeah.
Pretty simple.
Good point. Good point. Well, hey guys, thanks a lot for your time here this evening. Definitely appreciate it. We will be back on here after the Thanksgiving holiday. Be sure to check your schedules. We're coming up towards the end of the year, so make sure that you are getting your continuing education requirements met if you are wanting or intending to be an AFSP preparer for the coming tax season. The deadline for that is December 31st. So make sure you take a look there. Make sure you get those credits in before that deadline. Derek, Richard, any final points before we sign off?
Yeah, actually, anybody out there, if you have questions, concerns, comments, or anything connected to it, things you'd like to see, things you think needed more coverage or anything like that, feel free to send an email at webinar@federaldirecttax.com, and that'll pretty much get routed into my box, and I take these into consideration so we can try and make these improve, try to make them more relevant, and like have you guys involved in the feedback process.
Excellent. Well, hey, Derek, Richard, thanks a lot for the presentation tonight, guys. And again, everybody else on here, thanks for your time tonight. We look forward to seeing you guys again soon. Have a great night. Bye-bye.